We're almost onto the one-year anniversary of demonetization. 8th of November last year was a hectic, chaotic day with the government announcing that 500,000 rupee notes will no longer be valid. What followed now is for the history books. What we're still trying to understand, though, is what was the impact this had on the economy. That debate is still out there, and questions are still being asked whether there was an implication for supply chains and whether some of the downtick in GDP growth that we saw in the fourth quarter of last fiscal and the first quarter of this fiscal was related to demonetization. Joining us to talk through some of the economic impact or try and understand the economic impact is Sajjid Chinoy, Chief India Economist at JPMorgan. Sajjid, thanks so much for joining us. Appreciate you taking the time. Do you actually now, having had the benefit of hindsight, think that the economy did get hurt because of demonetization? What did it look like before we went into demonetization? And were the last couple of quarters of weakness linked to demonetization?
You know, in our view, growth began to slow much before demonetization. If you look at the numbers closely, GDP growth between April of 2016 and September of 2016, before demonetization, slowed by almost 200 basis points. And there are very good reasons why that should have happened. Number one, we've long maintained that the collapse in oil prices gave India a very large positive terms of trade shock that boosted growth. And therefore, in the year 2015-16, growth accelerated to 8%, despite it being a drought year, because a lot of this was underpinned by the falling oil prices and the positive terms of trade shock to households, to the government, to firms. That was always a one-time transitory effect. So as soon as oil prices stabilized, those growth benefits would begin to roll off, and we saw that happen early 2016, explaining some of the slowdown. The second reason was it was exactly in that period of time that policymakers correctly doubled down on deleveraging, on the asset recognition process, and that also contributed to the slowdown. So it's important to understand the macroeconomic context here. Growth was already slowing in the quarters before demonetization, both because the oil windfall had begun to roll off and we were getting very serious about bad asset recognition and the deleveraging process.
Let's try and look at the counterfactual, Sajjid. Is there any way of assessing where the economy may have been if demonetization had not happened?
You know, it's very hard to always analyze what the counterfactual may have been, what the economy would have been absent demonetization. But a couple of things I think are quite clear. One is there was a transitory near-term growth hit for a couple of quarters. So absent demonetization, GDP growth would have, would have been a little bit higher. The second was, in our view, we've had a temporary adverse supply shock. And what I mean by that is supply chains involving small, medium enterprises in the informal sector have been disrupted, and that activity has been replaced by much stronger imports, manufacturing imports. And that's the only way to rationalize why, even as domestic demand has been slowing the last 3 or 4 quarters, imports have been accelerating. So, you can reconcile those things when you recognize that this could have been an adverse supply shock. But remember, these near-term disruptions need to be traded off with the medium-term benefits. Already you've seen that there's been a big raft of financial savings post-demonetization. To be sure, this had started even before, but has been accelerated since. Cash holdings in the economy are less, and you can glean that by looking at the interbank liquidity surplus, which is still very sizable. And third, you've begun to broaden the tax base. The number of first-time or new tax filings this year is almost 27% higher than last year, and that's much more than the growth rate in previous years. So there are near-term costs that need to be traded off with more medium-term benefits.
Sajjid, in particular, there have been questions raised about the disruption to supply chains, first because of demonetization and then perhaps because GST followed so quickly after that. You have pointed out some data points, in particular on the import side, which suggest that there may be some supply disruption.
I think the best way to appreciate that this could be a temporary adverse supply shock is to look at the data. In the last quarter, where GDP growth slowed from 6.1% to 5.7%, the current account deficit quadrupled from 0.6% of GDP to 2.4% of GDP. Now, the widening of the current account deficit was not because of, largely because of weaker exports or oil imports or gold imports. 70% of the widening was because very strong, broad-based increase in manufacturing imports. So the puzzle is, in the last 6 or 7 months, imports have been growing at 15% a year when growth is slowing, compared to the fact that for the previous 2 years, imports were contracting at 5% a year. So how does one reconcile the fact that at a time where domestic demand is slowing, manufacturing imports are increasing, and they're very broad-based in nature across multiple sectors? Our rationale is that this is, demonetization and GST have likely disrupted supply chains that involves the informal sector, small and medium enterprises. I mean, ultimately, the whole goal of these reforms is to push the economy to become more formal. So the near-term cost is some of these informal firms have likely been affected, and as a consequence, larger firms that used to rely on these SMEs have had to import what they were previously purchasing at home, and that's how you explain weaker growth and this broad-based acceleration in imports over the last 8 or 9 months.
On the positive side, Sajjid, there are two things being pointed out. One, that digital transactions have increased, and second, that more money has gone into financial assets. The second one in particular would be beneficial for the economy for sure. But is that a tenuous link, or are you convinced that there is a link between demonetization and that change in trend?
I think it's undoubtedly the case that financial savings have increased even before demonetization for a number of reasons. I think the attractiveness of both real estate and gold has become less, and real rates have become positive, and therefore that's moved some savings away from physical assets to financial savings. But if you look at the data, it's undoubtedly the case that this process has sharply accelerated after demonetization. And I think the best way to understand this is you've had a lot of money come into the banking system, and yet a lot of that has remained in the formal network because currency in circulation is still now 20% less than it should have been pre-demonetization. And ultimately, these formal financial savings have to find their way somewhere, and in a way that explains why you've seen assets under management for mutual funds, for example, or life insurance subscription, for example, pick up quite dramatically after demonetization. So both things are true. There was a rising trend even before demonetization as SIPs became more broad-based and more fashionable, and that trend has accelerated sharply after demonetization.
All right, that's Sajjid Chinoy speaking to us about the economy. Sajjid, thanks so much for that.